For example, here's Apple, and this is 2 examples. So it had earnings on the 4th here. So you can see right here. And so it spiked up and then it went sideways, right? And then it started trending. Okay, so this is Apple. We'll show you that then paired with QQQ in a minute. And then here's Apple, again, earnings, collapses. It trends down, right? And then it starts up, right? That was on the 3rd. Okay, so here's what the spread looks like. This is just a correlated spread 1-to-1, where we're not adjusting the spread for a dollar value, which in the course I'll teach you how to do it dollar equivalent, where we're making it, if you have a value of 100 on one security, and we want to make the other value relative to 100. I'll show you how that's done and not confuse you. But this is just a 1-to-1 relationship. So if you bought 1 share of QQQ and sold 1 share of Apple, here's the spread. So at this point, on the 4th of May, that the spread on that spread value were QQQ minus Apple. QQQ at that time was $152 over Apple. If you did 1 share, you bought 1 share of QQQ and sold a share of Apple, that would have been, the spread would be $152, okay? Now, you can see, these are my indicators, which are really helpful, but you can see here after earnings, look what happened. The spread started trending. So this means that the spread, you're long QQQ, short Apple, that's all you're playing. If the market was going down, you don't care, you're just playing the spread. You think Apple is weak, and so you're going to take advantage of it but you're going to be paired or spreads. You're not going to be exposed directly to market moves. So let's say you thought Apple's going to be weak and you wanted to short it, but the markets are going up, so it's going up in your face gradually. But here's how you play it. So look at the spread. It went from 152 up to, on the July 18th, now it's 191 right here. Okay, went from here, right here, 191. So that's 191 from 152 to 191. That's a $36 per share move. Now we're going to do this with options. So 1 option contract is equivalent to 100 shares. So if you'd done this pair trade just 1-to-1, you'd be up $36 per 1 share, but we're going to do it with options. So you're up $3,600. That's 1 contract. So if you did 10, you can do the math, right? So really cool way to trade. And again, this is all I used to do was pair trade, my group. Okay, so here's another example. So here it is on the 3rd, and it's trading at 183 right here. And then on the 14th, it's trading at 201 right there. Okay, so here's the pair trade. So when it's going through here, you've got a very controlled risk, and you're hedged, right? So if the market did collapse, you're hedged. So, you're long short, but so the trend did move up. And so from that, it went up to, that's an $18 move, okay? So here you'd be up $18 per share. That'd be $1,800 per option contract, doing it as a pairs using options, which I'll show you in the course.